In the annals of financial history, few events loom as large as the Great Crash of 1929. It was a cataclysm that didn't just wipe out fortunes, it plunged the world into the Great Depression, a decade of unparalleled economic hardship. We look back at it as a relic of a bygone era, a cautionary tale from a less sophisticated time. But what if I told you that the ghost of 1929 is not just haunting us, but is actively walking among us? That the same toxic cocktail of debt, rampant speculation, and insatiable corporate greed that brought the world to its knees a century ago is brewing once again, right under our noses. In this video, we're going to pull back the curtain and uncover the shocking parallels between the Roaring Twenties and our current market environment. We'll explore how the lessons of the past are being willfully ignored and what the terrifying consequences could be if history decides to repeat itself. This isn't just a history lesson. It's a stark warning about a future that could be just around the corner, a potential financial collapse in 2025 that almost no one sees coming. So, stay with us as we connect the dots and reveal why the 1929 crash might be happening all over again. The Roaring Twenties were a time of unprecedented optimism, an era defined by jazz, flappers, and a seemingly endless stock market boom. From 1921 to the summer of 1929, the Dow Jones Industrial Average skyrocketed, increasing more than six-fold. It was a national obsession. Stories of shoeshine boys and waitresses giving stock tips became legendary. The belief was that the market could only go up, that a new era of permanent prosperity had dawned. This frenzy was fueled by a dangerous new tool, buying on margin. Everyday people were borrowing huge sums of money, sometimes putting down as little as 10% of a stock's value, to speculate on the market. They were betting the farm, and their broker's farm too, on the certainty of ever-rising prices. This created a massive, unstable bubble, where stock valuations became completely detached from the underlying health of the companies they represented. Now, fast forward to today. Does any of this sound familiar? We've witnessed a similar decade-long bull run, where major indices have shattered records time and time again. We've seen the rise of meme stocks, cryptocurrencies, and speculative assets with little to no intrinsic value, all driven by a social media-fueled frenzy. The modern equivalent of buying on margin is readily available through user-friendly trading apps that offer easy leverage, encouraging a new generation of retail investors to take on massive risks. Just like in the 1920s, a pervasive belief has taken hold that the market is a one-way ticket to wealth, a game that can't be lost as long as you buy the dip. The technology has changed, but the human psychology, the intoxicating allure of easy money and the fear of missing out, is identical. The foundation of our current market, much like the one in 1929, is built not on solid value, but on a precarious mountain of speculative hope. One of the most critical and often overlooked parallels between the 1920s and today is the staggering level of debt. Back then, it was a combination of margin debt for stock speculation and the explosion of consumer credit. For the first time, ordinary Americans could buy cars, radios, and home appliances on installment plans. Buy now, pay later became the mantra of the decade. This created an illusion of widespread prosperity, but it was a prosperity built on borrowing from the future. Corporate America was also gorging on debt, financing massive expansions and engaging in complex financial engineering through holding companies and investment trusts, creating opaque structures that hid immense risks. When the music stopped in 1929, this web of debt became a transmission mechanism for the crisis. As people lost their jobs and savings, they defaulted on their loans, causing banks to fail, which in turn triggered more defaults and more failures in a catastrophic domino effect. Today, we are living in the most indebted period in human history. Global debt, including government, corporate, and household debt, has soared to astronomical levels, far exceeding what was seen before the 2008 financial crisis, let alone 1929. Governments have borrowed trillions to stimulate economies. Corporations have loaded up on cheap debt to fund stock buybacks rather than productive investment. And consumers are more reliant than ever on credit cards, auto loans, and mortgages. This colossal debt burden makes the entire global financial system incredibly fragile. A significant economic downturn, a spike in interest rates, or a geopolitical shock could trigger a wave of defaults far greater than what was experienced in the 1930s. The debt that fueled our apparent recovery is the very same powder keg that threatens to blow the entire system apart, repeating the most destructive lesson of 1929 on a scale that is almost unimaginable. Compounding the issues of speculation and debt is the insidious role of corporate greed, which has mirrored the patterns of the 1920s with chilling accuracy. In the years leading up to the crash, corporate profits soared, but this wealth was not shared. Wages for the average worker remained stagnant, leading to a massive and destabilizing wealth gap. The richest 1% of Americans saw their share of national income balloon, while the bottom 90% struggled. Corporations, instead of reinvesting their profits into their businesses or their workforce, poured money into the stock market, buying back their own shares to artificially inflate their value and enrich executives and large shareholders. This financial maneuvering created a facade of corporate health, while the real economy, the one dependent on consumer purchasing power, was weakening. Does this sound familiar? It should. Today, we are experiencing the most extreme levels of income and wealth inequality since, you guessed it, the late 1920s. For decades, corporate profits have detached from employee wages. We see corporations posting record earnings while simultaneously laying off workers and resisting wage increases. The primary use of this corporate cash has been a relentless wave of stock buybacks, which have reached trillions of dollars in recent years. This practice does little to improve the long-term health or productivity of a company. Its main purpose is to boost the stock price in the short term, triggering executive bonuses and rewarding investors. Just like in the 1920s, this focus on short-term financial engineering starves the real economy of vital investment and widens the gap between the ultra-rich and everyone else. It creates a system that prioritizes the paper wealth of a few over the sustainable prosperity of the many, sowing the seeds of its own destruction by hollowing out the very consumer base it needs to survive. Perhaps the most terrifying parallel of all is not the economic conditions themselves, but the deliberate blindness of those in charge. In the months leading up to the October 1929 crash, prominent economists, politicians, and financiers publicly dismissed any concerns. The famous economist Irving Fisher declared just days before the collapse that stock prices had reached what looks like a permanently high plateau. Political leaders assured the public that the fundamentals of the economy were sound. They were either blissfully ignorant or willfully dishonest, unwilling to acknowledge the glaring warning signs and risk disrupting the party. The Federal Reserve, the nation's central bank, made critical policy errors, first by allowing the speculative bubble to inflate and then by tightening monetary policy at precisely the wrong moment, pricking the bubble and exacerbating the subsequent collapse. Today, we hear the same chorus of reassurance. Central bankers, government officials, and market analysts consistently downplay the risks. They point to manipulated inflation numbers and low unemployment figures as proof of a healthy economy, all while ignoring the colossal debt bubbles, the speculative froth, and the historic levels of inequality. They have become prisoners of their own policies, trapped in a cycle of creating cheap money to prop up asset prices, fearing that any attempt to normalize policy will cause the very collapse they are trying to prevent. They tell us that this time is different, that they have the tools to manage any crisis. But this confidence echoes the same hubris displayed in 1929. The warning signs, from inverted yield curves to extreme market valuations, are flashing red, just as they did a century ago. Yet the experts, the very people we trust to safeguard our economic future, seem to be looking the other way, assuring us that the ship is unsinkable, even as it steers directly toward a familiar iceberg. If this house of cards collapses, the fallout could make 1929 look like a minor tremor. The global economy is infinitely more interconnected and complex than it was a century ago. A crash would not be confined to Wall Street. It would be an instantaneous global contagion. The crisis would likely begin in the credit markets, as highly indebted zombie corporations, which only survive by taking on new debt to pay off old, begin to default en masse. This would freeze the lending markets, triggering a credit crunch that would starve even healthy businesses of the capital they need to operate. The stock market would plummet as panic selling takes hold, wiping out trillions of dollars in retirement savings and pension funds overnight. The interconnectedness of the global financial system means that the failure of a major bank or financial institution in one country could set off a domino effect across the globe, leading to a cascade of failures. We could see mass layoffs on a scale that dwarfs what we saw in 2008. Governments, already buried under mountains of debt, would have limited firepower to intervene. The tools they used in the past, like slashing interest rates and quantitative easing, are already exhausted. With interest rates near zero and balance sheets already bloated, what ammunition do they have left? The social and political consequences would be severe. A global depression could fuel civil unrest, extreme political movements, and a breakdown of international cooperation. The carefully constructed global order of the past 75 years could unravel. This is not fear-mongering. It is a sober assessment of the fragilities built into our system. We are repeating the same mistakes of 1929, speculation, debt, and greed, but on a globalized, hyper-leveraged scale. The coming collapse may not be a simple market correction. It could be a fundamental reset of the global economy, with consequences that will shape the remainder of the 21st century. So, as we stand on this precarious precipice, looking down from a height that rivals the dizzying peak of 1929, the question is not if the parallels will converge, but when. We have seen how the speculative mania, the crippling levels of debt, and the staggering inequality of the Roaring Twenties are not just echoes from the past, but living realities in our modern world. We've seen how the assurances of today's experts mirror the misguided confidence of their predecessors, who promised a permanent plateau of prosperity just before the world fell off a cliff. The lessons of history are written in the stark language of economic ruin and human suffering, yet we seem determined to ignore them. The path we are on leads to a dangerous destination, a reckoning that could dwarf the crises that have come before. Thank you for watching. And if you're as concerned about the future of the global economy as we are, make sure to subscribe and hit that notification bell.